Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. I drew 5 weeks ago an early July to mid-November 2023 bearish Andrews pitchfork, which I've since highlighted in purple on my daily chart. At the time, it was more as a way of expressing the bearish angle of attack here than for anything else. And in this, it has been accurate in showing the way lower and the bearish angle of attack, though I do note that prices have stayed away from the upper and lower times since its creation. Currently they're 1260 and 1070 respectively. Instead, the market chose to stick fairly closely to the middle time, currently at 1167. During the move down, the market had some hesitation in January. This hesitation created a small descending wedge pattern over January and into February, which you can see highlighted in dark blue on my daily chart. Maybe just the aesthetics, but the way the descending wedge pattern sits makes it look like it's pointing the way lower. This observation does not back up this idea, of course, it's just an observation. However, it has been accurate in this instance until 2 weeks ago, when the market departed at a more acutely bearish angle lower. This move lower soon hit support, notably the December 2020 lower 1143, which held and turned the market back up late last week into this week. This turn is both surprising and somewhat amazing, as we really had no further support below until the 61.8% absolute Fibonacci line at 1106. So, from the December 2020 low, prices turned back up a little and are currently testing congestion in the 1161 area overhead. I am mindful that the bearish pressure of the middle time is not that far away and will cross the 1161 resistance early next week. So that is worth watching to see what happens next. But until then, the bearish Andrews pitchfork still rules. The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal. And that was, and is, the well-highlighted annual key reversal down we saw here for 2023. Not directly related here, but not worth ignoring either. Chicago soybean meal. After establishing a horn top in mid-November 2023, something I'd cautioned about 15 weeks ago, prices dropped down through some major supports, and in the process of heading lower, created two lagging indicators, dead crosses, if you will, of the short medium moving average, currently 362.70, down through the long moving average, currently 394.90, and down through also the medium moving average, currently 385.90. In mid-January, prices hit the congestion zone 363.70 to 368.80. And this was where I had cautioned 13 weeks ago we might see some hesitation due to the low we saw back in October 2023. Well, prices sliced through this congestion, but in the process, the erosion there caused another hesitation, this time between the original congestion area of 363.70 to 368.80, and then the next smaller congestion area below around 349.20. This hesitation was formed over January, but broke down in the early part of February. We then had a small area free from congestion until the small congestion seen at 342 even. And then again, further congestion below, between 336.30 to 338.10. This latter one contains the 61.8% absolute Fibonacci line at 336.30. After a first attempt lower 3 weeks ago, the congestion support gave way in the middle of the week, 2 weeks ago, and dropped down to the next congestion below, which is 326.90. However, this congestion was different as we had crossing through it the extension to the lower trend line, currently 326.90, of the July to September 2021 descending triangle. I've highlighted this trend line in dark blue on my daily chart. Now, as I said last week, and I quote, "This may be nothing, but I am minded after such a fall as we've seen since last November last year, that this may, just may, see some hesitation around the 327 to 325 zone. I'm not certain on that, but it is worth considering. However, the overall pressure is still bearish, and we must now consider the congestion in January that ran into early February as a possible bearish halfway hesitation." End of quote. Now, the question I had last time was, and I quote, "Where to measure it from?" That's the bearish halfway hesitation. The most obvious immediate point is the uptick in late December, in which case it would provide us with potential down to just a little under where we are now, in the low 320 zone. However, if we were to consider the move starting at the high in November last year, then there is potential down into the 270 zone, well below the bottom of my daily chart. It is too early to say whether the 270 zone will become a target or not, but it is worth considering. End of quote. So, what do we have in the way to halt any decline? Well, to be frank, not much. We have the October 2021 low sitting very much on its own at 309.30, but we really don't have much else until we run into congestion from 2020 between 300 even down to 282 even. So pay special attention to any moves down to the 309 zone, and then any moves below it should it get there. However, the market is, I suspect, fully aware of this, which is why we have seen for the last 2 weeks hesitation between roughly 323.30 up to the 61.8% Fibonacci line. It may be that the market is getting a touch of anxiety about this all, or as I prefer to call it, the heebie-jeebies. We shall see. Finally, I'll raise once again the one key feature I need to repeat and emphasize, as I've done so in the past. I raised it as a possible feature 38 weeks ago, and it came to fruition at the close of 2023. It was that 2023 was an annual key reversal down year. This hangs over all of this market more than anything right now, and all action should be seen in the shadow of this pattern. Chicago soybean oil. The 4-week-old bull channel back in November last year quickly ran out of steam, capped by the combination of the sine wave that is highlighted in green on my daily chart of the declining short medium moving average, currently at 47.17, and also the same February 2013 high support that is now resistance at 54.15. Remember the short medium moving average, as it will come up again later in my commentary. In early December last year, prices broke out below this small bull channel, though the move lower has not been as easy as it was back in autumn 2023. Eventually, at the turn of the year, the market broke down through the 38.2% Fibonacci line at 48.95. We had the opportunity to form a very extensive bearish halfway hesitation, with the bear channel being one leg and the bull channel being the hesitation, with potential being as low as 40 even. That's 40 even. However, the decline, and we have had a decline, has been shallower than in autumn last year. Interestingly, possibly being dictated on top by the now shallowly declining short medium moving average in green. I told you it will crop up again. Prices are now down to the area of congestion we last saw in May 2023, consisting of 3, possibly 4 bands. These are at 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 2013 low at 44.68. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94. Then the interesting 42.65 congestion, which had the neckline of the October 2019 to February 2020 head and shoulders top running just above it. That's currently at 42.87. And also, I suppose we also have congestion further down at 41.15. I mention all this because some 35 weeks ago, and numerous times ever since, I said the following about the big descending wedge pattern that was on my daily chart back then and is high up off the top of my chart now. I said the following, and I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern," end of quote. This is a big pattern idea, and the market decline since autumn of last year fits in with this idea, with the expectations I voiced of eventually witnessing a fall down to the area of the May and June lows, between 48 even to 46 even, which is where we've recently been and are currently just below. Wow, thereabouts. I'm now keeping a very, very close eye on this idea, as any significant breakdown below the 48 even to 46 zone could signal the start of this move lower. So far, I'm not convinced of the move, that we've seen this break lower already. No, not just yet. However, three things that need to be borne in mind. Firstly, this is a really big pattern idea, stretching from November 2022 to date. So do not expect any immediate sharp movements. Secondly, data indicates about 3 out of 4 times the market breaks lower in such a pattern. Just be aware of that. Finally, I would like to float the idea of a recent unusual bear channel. Now, I've highlighted the lower bear channel line dating from the start of 2023 in dark blue on my daily chart, and it's currently 43.53. I could have drawn a second trend line, an upper bear channel line, and I have actually. Currently that's at 48.22, but I chose not to highlight it, and it was for a reason. You see, I've chosen instead for now to utilize the declining short medium moving average in green as the upper bear channel line. That's currently at 47.17. There is a simplicity about looking at it this way, so pay special attention to the blues and the greens on any moves.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.